Listen, I want you to picture something real. It is a Wednesday afternoon in suburban Phoenix, Arizona, and Margaret is standing in her kitchen holding a coffee mug she does not recognize. The mug was painted by her granddaughter Olivia in second grade and given to her in 2019 for Mother's Day. The handprint on the side is faded now from 7 years of dishwasher cycles. Margaret has held this mug almost every morning for those 7 years. And right now, on this particular Wednesday in May of 2026, she is staring at it the way you stare at a stranger's wallet that fell on the sidewalk in front of you. She is 72 years old. Her husband Walter died 3 years ago on a Tuesday morning in the cardiac ward at Banner Health, with a Diet Coke can on the bedside table and a baseball game muted on the wall-mounted TV. The house is paid off, has been since 2011 when they made the last triumphant payment on the kitchen calendar with a red Sharpie circle and a small drawing of a champagne bottle Walter had insisted on adding. Her traditional IRA, the one she rolled over from the Mesa School District pension 12 years ago, sits at $487,000. Her joint checking account, still in both their names because she could not bear to change it, holds about $43,000. There is another savings account at the credit union with $61,000. There is a brokerage account that Walter set up in 1998 with another $112,000 in it, mostly in a Vanguard balance fund he stopped looking at in 2004. She does not remember any of these numbers anymore. She does not remember the credit union exists. Her daughter Sarah, who lives in Atlanta and works in pharmaceutical sales, has been getting strange phone calls for 6 months. Mom forgetting which day is trash day. Mom calling on Tuesday to ask if Christmas was last weekend. Mom paying the water bill twice in the same month and then accusing the utility company of theft and threatening to write to the Arizona Attorney General. Mom calling Sarah by the name of her sister Patricia, who passed away in 1998. Sarah finally flew down last week. She found unopened mail going back to February stacked on the dining room table. She found 3 different cans of green beans in the bathroom cabinet under the sink. She found her mother sitting on the front porch in a winter coat in 91-degree heat, watching the neighbor's lawn sprinkler like it was a Broadway show. The doctor used a word Margaret did not like. The doctor used several words. The most important word was conservatorship. Now here is what nobody told Margaret. Here is what your financial advisor, the one in the navy blazer, who took you to that prime rib lunch in 2019, and called it a portfolio review and picked up the check with the studied casualness of a man billing it to a corporate card, never mentioned. Here is what your CPA, the one who has been doing your taxes for 19 years and charges you $385, every March has been carefully not bringing up. Here's the part that the friendly commercials with the silver-haired couple on the sailboat will never, ever explain. The moment a probate judge signs the order, the moment that signature touches the paper in a courtroom, Margaret will never see, in a city Margaret has not driven to in 11 years, on a docket she will not appear on. Every single one of those accounts I just listed stops belonging to Margaret in any meaningful sense. Not legally, not practically, not functionally. The judge, a man Margaret has never met named Judge Daniels, who took the bench in 2018 after 22 years in private practice, now controls 100% of her assets. Sarah cannot touch the IRA. Sarah cannot withdraw from checking. Sarah cannot sell the house. Sarah cannot pay the property taxes, the homeowner's insurance, the new roof estimate Sam at the roofing company emailed in March, or the Medicare supplement premium without filing a petition and waiting 6 to 14 weeks for a hearing. And every petition costs money. And the conservator the judge appoints, who may or may not be, Sarah, and frequently is not, gets to charge fees. Usually somewhere between $4,000 and $11,000 a year for a basic case. Sometimes north of $30,000. Court costs, attorney fees, annual accounting fees, bond premiums, investigator fees, all paid out of Margaret's money, all without Margaret's consent, all without Sarah's veto. This is not a horror story. This is the law in 49 states. This is happening right now in the time it takes you to make a second cup of coffee. Now, before I go a single word further, I need you to do one specific thing. Smash the like button on this video. Not because I need it for vanity, because the algorithm on this platform in 2026 has a documented suppression problem on senior financial content. Every credible review from the last 18 months says the same thing, and AARP published a piece earlier this year on platform throttling of retirement-oriented warnings. Videos that warn the over 60 audience about asset seizure, conservatorship abuse, and Medicaid look-back enforcement get pulled from the homepage. The platforms do not want this video reaching the people who need it. Their ad partners are the same financial services firms that profit when you stay confused. Your like is not a thumbs up to me. Your like is a signal to the machine that says push this to one more grandmother in Tampa. Push this to one more retired teacher in Akron. Push this to one more 71-year-old widower in Sacramento who is sitting on a paid-off ranch house and a $620,000 IRA and has no durable power of attorney filed anywhere on this earth. Subscribe and hit the bell. Subscribe because in the next 6 to 8 videos, I'm going to walk through the exact paperwork sequence that stops a conservatorship before it starts. The specific Roth conversion timing for a single survivor versus a married couple. The trust structure that survives a 2026 audit. And the IRA beneficiary language that keeps the IRS away from your grandchildren. The bell because the moment one of these warnings drops, you want to see it the day it lands, not 3 weeks later when your sister-in-law forwards it after the diagnosis is already in the file. The suits in the legal department want me to remind you that I am not your financial advisor, I am not your estate attorney, and this is not legal or tax advice. This is a survival manual for the American retiree who does not know that the probate system in their state is engineered to extract value from them the moment they become legally incapable. I spent over 3 decades inside that system. I am telling you what I was forbidden from telling clients while I was still drawing a paycheck. Use it however you want. Now back to Margaret. Let me tell you what actually happened mathematically, word by word, so you understand the size of the crime. There are 3 layers to this trap. The first layer is the conservatorship itself. The second layer is the tax bomb buried inside Margaret's traditional IRA. The third layer is what happens to the joint accounts and the house when the state takes the wheel. Start with layer 1, the conservatorship. Every state in America has some version of this law, and the legal name varies. In California, it is called a conservatorship of the estate. In Florida, it is called a guardianship of the property. In Ohio, it is called a guardianship over the person and estate. In Texas, it is called a guardianship of the estate of an incapacitated person. The labels are different. The mechanics are identical. When a court determines that an adult lacks the capacity to manage their own financial affairs, and the bar for that determination in most states is shockingly low. Often a single physician's letter and a brief, court-appointed evaluator interview that may last under 30 minutes. The court appoints a third party to take control. That third party is the conservator or the guardian. That person can be a family member, but in roughly 30% of cases nationally, according to reporting compiled by the AARP Public Policy Institute, the court appoints a professional fiduciary instead, a stranger, someone the family has never met, someone who bills by the hour, someone whose fee structure is approved by the same court that appointed them. Once that appointment is made, the conservator has fiduciary control over every single asset titled in Margaret's name. The IRA, the brokerage account, the bank accounts, the vehicles, the house, even the jewelry if it appraises above the state's exempt threshold, and in some states the threshold is as low as $5,000. Margaret does not get to write a check for $500 without the conservator's signature. Margaret does not get to gift her granddaughter $250 for a birthday. Margaret does not get to donate to her church. Margaret does not get to buy a new winter coat without the line item appearing on the annual accounting filed with the court and reviewed by the court investigator on a billable hour. And here's the part nobody tells you when the dementia diagnosis arrives. The conservator is not legally required to follow Margaret's previously stated wishes, unless those wishes were documented in a binding instrument before the incapacity. A verbal preference does not count. A note in the kitchen drawer does not count. A handwritten letter to Sarah does not count. An email Margaret sent in 2022 saying she wanted to keep the house no matter what does not count. The only documents that count are a durable power of attorney executed before incapacity, a revocable living trust funded before incapacity, an advance healthcare directive, and a HIPAA release. If those four documents are not in place and properly executed under your state's current statutes, the judge has near total discretion. The judge does not know Margaret. The judge does not know Walter. The judge knows the docket and the calendar and the next hearing. That is layer 1. Now layer 2. And this is where the math starts to hurt. Margaret's IRA is $487,000, all pre-tax. Every dollar in there has never been taxed because she contributed it through her school district's 403B, which rolled into a traditional IRA when she retired in 2014. The contributions came out of her paycheck pre-tax. The employer match was pre-tax. Every dollar of dividend reinvestment and capital gains has compounded pre-tax. Walter used to call it the deferred dragon. Now, once a conservator is appointed, that conservator has a legal duty to manage Margaret's care. Margaret needs assisted living, specifically a memory care unit. The average cost of memory care in Phoenix in 2026 sits somewhere in the $7,800 to $9,400 per month range, depending on the facility's licensing tier. Call it $100,000 a year. Margaret does not have $100,000 in cash sitting around. The conservator has to liquidate something to pay for it. The first place every conservator goes is the IRA, not the house, because selling the house requires another court order and probably a real estate broker, and 4 to 7 months of listing time. Not the brokerage account, because there are tax loss harvesting considerations the conservator does not have time for. The IRA is the cleanest liquidation. Click the button, sell the mutual funds, transfer the cash, write the check to the memory care facility before the late fee kicks in. Here's the dirty trick the IRS plays. Every dollar that comes out of that traditional IRA is taxed as ordinary income to Margaret in the year of distribution. Margaret's other income, Social Security, of roughly $32,000 annually, plus the small Walter Survivor benefit, puts her in a comfortable place tax-wise on her own. But the moment the conservator pulls $100,000 out of the IRA to pay the facility, Margaret's adjusted gross income for that year balloons past $130,000. She crosses the IRMAA threshold. Her Medicare Part B premium for the following year jumps from the standard rate of roughly $185 a month to over $370 a month. Her Part D premium gets a surcharge. The provisional income calculation now taxes 85% of her Social Security benefit, and approximately $22,000 of that $100,000 withdrawal goes straight to the federal government as ordinary income tax. Now multiply that by year 2 and year 3. Margaret survives, on average, for moderate stage dementia, diagnosed at age 72, somewhere between 4 and 8 years in care. Every single year, the conservator pulls another $100,000 to $120,000 out of the IRA to pay the facility, which raises rates roughly 4 to 6% annually because long-term care inflation runs hot. Every single year, Margaret pays the IRMAA penalty, the ordinary income tax, the Social Security inclusion penalty. Over 6 years, the cumulative federal tax bill on those liquidations is somewhere north of $130,000. That is $130,000 that Sarah will not inherit. That is $130,000 that the IRS extracts because the conservator had no choice and no time to plan. This is not an accident. This is the tax code working exactly the way it was written. The same Internal Revenue Code section that lets you defer taxes on the way in, IRC Section 408 and its related provisions, is the same one that maximizes the tax on the way out. There is no provision for compassionate distribution. There is no special bracket for dementia care withdrawals. There is no override for a court-ordered liquidation. The IRS does not care that Margaret has Alzheimer's. The IRS sees ordinary income on a 1099-R and processes the return on the same automated system that processes a 30-year-old's freelance income. Layer 3 is the bank accounts and the house, the joint checking with Walter's name still on it. That account, in most states, is now legally Margaret's alone since Walter's deceased, because joint tenancy with right of survivorship transferred sole ownership the day the death certificate posted. Sarah's name is not on it. Sarah was never added. When the conservatorship is filed, the bank freezes that account pending court order. The bank's liability for letting funds move out of a potentially incapacitated person's account before a court appointment is greater than the customer service damage from freezing it. Margaret cannot access her own money. The auto pay for the electric bill bounces. The auto pay for the property tax bounces. The Medicare supplement premium bounces. Sarah, sitting in Atlanta, gets the angry phone calls from APS and the utility company and cannot fix any of it without a court hearing. The house, the paid-off ranch in Phoenix worth approximately $390,000 in the 2026 market, is now an asset of the conservatorship estate. If the conservator decides Margaret can no longer safely live there, and given the dementia diagnosis, that decision is essentially automatic. The conservator petitions the court to list the house for sale. The proceeds go into a court-supervised account. Sarah's childhood home, the one Walter built the back porch on in 1987 over 3 weekends with his brother-in-law Donnie, the one with the kitchen Margaret repainted Wedgwood blue in 2003, gets sold to whoever shows up with a cash offer first. The conservator takes a fee. The realtor takes a commission. The probate attorney takes a fee. The court takes a filing fee. And every dollar that touches that conservatorship estate during Margaret's remaining years generates billable activity. The conservator's annual accounting must be filed with the court. The attorney representing the conservator must review it. The court investigator must independently review it. The court must approve it. Each of those steps is a billable event. Sarah will receive itemized invoices for hours she did not request and decisions she did not authorize. By the time Margaret passes away, the conservatorship will have consumed somewhere between $90,000 and $240,000 in administrative costs alone. That number does not include the tax liability. That number does not include the lost compounding on the IRA. That is just the friction cost of having a judge run your mother's life. 3 layers: conservatorship control, IRA tax bomb, account freeze plus house liquidation, stacked on top of each other like a Russian nesting doll designed by an accountant. Engineered to extract maximum value from a 72-year-old widow who, in the year 2018, when she should have been doing estate planning, was busy taking care of Walter through his cancer and never got around to it. The system does not have a clause for that. The system is patient. Now let me tell you who built this and why it has not been fixed. The framework for modern adult guardianship law traces back to the Uniform Guardianship and Protective Proceedings Act, originally drafted by the Uniform Law Commission in 1982 and revised most recently as the Uniform Guardianship, Conservatorship, and Other Protective Arrangements Act in 2017. 38 states have adopted some version of that framework. The intent, on paper, was reasonable. Provide a legal mechanism to protect adults who cannot protect themselves from financial exploitation. The execution has been a disaster. The National Council on Disability published a 200-page report in 2018 titled Beyond Guardianship that documented systemic abuse, financial exploitation by court-appointed guardians, and a near-total absence of oversight. The Government Accountability Office published its own report on professional guardian abuse in 2010 and a follow-up in 2016. The Senate Special Committee on Aging held hearings on this in 2018, 2021, and again in late 2024. The findings are consistent and damning. The system is opaque. The fees are unregulated. The conflicts of interest are structural. The state probate courts that oversee conservators are themselves funded in part by conservatorship filing fees and percentage assessments on the estates they administer. The court has a financial incentive to approve more conservatorships, not fewer. The court has a financial incentive to extend them, not terminate them. The federal government has done effectively nothing structural. The Older Americans Act has been reauthorized multiple times without meaningfully addressing guardianship abuse. The Department of Justice has issued guidance documents that read like polite suggestions to states that ignore them. The IRS has zero interest in providing relief on the tax bomb because the tax bomb is revenue. And revenue projections funded by court-ordered IRA liquidations show up in the Joint Committee on Taxation's baseline forecasts for the next decade. The state legislatures have been slightly more active. California passed reforms in 2021 in the wake of the widely covered celebrity conservatorship case that put the system on cable news for the first time in a generation. Florida has tightened reporting requirements in stages since 2015. Pennsylvania revised its guardianship procedures in 2023. The changes are procedural, not structural. The underlying mechanic remains intact. A judge can still seize 100% of an adult's financial life based on a single physician's letter and a 20-minute hearing the adult does not attend and may not even know is happening. Why has nobody fixed it? Because the people most likely to be harmed by it, adults in early cognitive decline, their families dealing with crisis, the elderly poor, the elderly middle class, do not constitute an organized political constituency. There is no AARP equivalent for conservatorship victims. There is no PAC. There is no senator running for re-election on guardianship reform. The system is patient. The system is waiting. The system has been designed and refined for 40 years to extract value, quietly, one family at a time, in courtrooms nobody televises, and on dockets that move too fast for the local newspaper to cover. That is the villain. Not a person, not a party. The design itself. Now stop the video right now. I want you to do one thing. Drop a comment below with 3 pieces of information: your state, your age, and the dollar value of the largest single account you currently hold. IRA, 401k, brokerage, savings, whichever is biggest. You can make it a range if you want. You do not need to give me a number to the dollar. Texas, 71, 400 to 600,000. Ohio, 68, 200 to 400,000. Florida, 73, 600E plus. That format, the comment section, is the field hospital on this channel. I read every single one of them, and on the live streams I read them out loud. When the comments come in, I see the geographic distribution. I see the age clustering. I see the dollar exposure, and I use that to figure out which state-specific deep dives go next. Drop your field report. If you want, add a 4th line, yes or no, durable power of attorney on file. That single yes or no answer is the most important data point on this entire channel. If you do not have a durable POA executed, properly notarized, and held by a person you trust, you are Margaret. You are 7 months from a diagnosis you have not received yet. You are 1 fall, 1 stroke, 1 episode of unexplained confusion at the grocery store away from a probate judge reading your name off a docket. I will respond to as many of these comments as I can over the next 72 hours. Every state has different rules, and one script cannot cover all 50. The comments are how I get specific with you. The comments are how the next video gets written. Now let me show you how to make sure none of this happens to you. This is the part of their video the financial industry never gives you for free, because the financial industry makes money managing your traditional IRA and loses revenue the moment you move it. The 2 accounts you need to drain, and I am using drain in a specific, deliberate, legal sense, are your traditional IRA or 401k and your jointly held bank accounts. Drain means move the dollars out of vulnerable account structures and into structures that survive incapacity intact. Let me walk you through both moves, and then I am going to give you the side-by-side scenario, Margaret, who planned versus Margaret who did not, so you can see the gap in real dollars. Move 1, the traditional IRA. The reason you must drain this account before incapacity is that every dollar in there is a delayed tax bomb. While you are competent, you control the timing of withdrawals. You can spread them over years, manage your bracket, stay under the IRMAA threshold, time conversions around capital losses, harvest from your taxable brokerage account first when markets are down. The moment a conservator takes over, that strategic control evaporates. The conservator pulls money when bills are due. The conservator does not care about your bracket. The conservator cares about the invoice from the memory care facility that is 14 days overdue. The legal technique to neutralize the bomb is the Roth conversion ladder. Specifically, a multi-year staged conversion of your traditional IRA balance into a Roth IRA, executed before you experience any cognitive decline in years where your other taxable income is unusually low. For a married couple over 65 in 2026, the 12% federal bracket runs comfortably into the upper double-digit thousands of taxable income after the standard deduction and the senior bonus deduction stacked on top. The standard deduction for married filing jointly in 2026 sits at roughly $30,700, and the additional age 65 amount adds another $1,600 per spouse. That means there is meaningful room every year, sometimes $30,000, sometimes $50,000, sometimes more, where you can convert chunks of your traditional IRA into a Roth IRA at a 12% effective rate. Write the tax check from your taxable account and lock in tax-free growth forever. Once those dollars are in a Roth, 3 things change. 1. No required minimum distributions during your lifetime. The Roth IRA has no RMD for the original owner, which means at age 73, you are not forced to pull anything out and incur tax. 2. No federal income tax on qualified withdrawals. Your conservator, if one is ever appointed, can pull from the Roth to pay your care without generating a single dollar of taxable income. 3. When you die, your children inherit the Roth, and under Secure Act rules they have 10 years to distribute it. But every dollar of that distribution is also tax-free, which means Sarah is not going to receive a $487,000 inheritance and lose $140,000 of it to her own ordinary income tax bracket during her highest earning years. The math is brutal in the right direction. Margaret's $487,000 IRA, if converted to a Roth over an 8-year ladder starting at age 64 in 2018, would have generated approximately $90,000 to $110,000 in total federal tax during the conversion years, spread across 8 tax returns at manageable bracket levels. The remaining $377,000 to $397,000 ends up in a Roth, growing tax-free, withdrawable tax-free, and inheritable tax-free. Compare that to the trajectory she is actually on. 6 years of conservator-driven distributions generating north of $130,000 in cumulative federal tax, plus IRMA penalties, plus the Social Security inclusion penalty, plus the loss of compounding. The gap between these two outcomes, the planned Margaret and the unplanned Margaret, is somewhere north of $180,000 in tax alone, before you add the conservatorship friction cost. Move 2. The jointly held bank accounts and the brokerage. These need to come out of joint tenancy with a deceased spouse, which is not really joint tenancy anymore. It is sole tenancy with a ghost on the title, and into a revocable living trust. A revocable living trust is a legal entity you create, you control, you fund with your assets, and you can dissolve at any time while competent. You name yourself as the trustee. You name a successor trustee, usually a trusted adult child or 2 adult children jointly, to take over the moment you become incapacitated. The key word is incapacitated, not deceased. Most properly drafted revocable trusts include an incapacity clause that automatically transfers trustee control to the successor upon documentation of incapacity, typically a letter from 1 or 2 physicians, depending on the trust language. That transfer happens outside of probate court. No judge, no filing fee, no conservator appointment, no annual accounting to a state probate division. Sarah, sitting in Atlanta, gets the 2 physician letters, presents them to the bank along with the trust document and her own identification, and the bank transitions her to signatory authority on every account titled in the name of the trust. The freeze never happens. The autopay continues. The Medicare supplement gets paid. The property taxes get paid. The new roof gets installed. The granddaughter still gets her birthday card with $250 in it and a hallmark with a butterfly on the cover. The mechanics of moving assets into the trust are straightforward but tedious. Each bank account gets retitled. Each brokerage account gets retitled. The house gets a new deed transferring ownership from Margaret individually to Margaret, as trustee of the Margaret Family Trust dated whatever date the trust was executed. The IRA does not go into the trust. IRAs cannot be retitled into a trust without triggering immediate taxation under IRC Section 408. But the IRA can name the trust as the contingent beneficiary, or better yet, name a properly structured see-through trust as primary beneficiary, which preserves the protective structure for the after-death distribution under Secure Act rules. The cost of executing all of this with a competent estate planning attorney in 2026 sits somewhere in the $2,500 to $6,000 range for a basic estate, $5,000 to $12,000 for a more complex one with multiple properties or business interests. That sounds expensive. It is roughly 1/20th of what the conservatorship will cost if you skip this step. It is roughly 1/40th of the tax bomb if you skip the Roth ladder. The math is not close. Now the side-by-side scenario, and I want you to listen to this part carefully because this is the single move that puts $180,000 to $300,000 back into your family's pocket. Margaret A., the planned Margaret, executed her estate documents in 2017 at age 63. 18 months after Walter's first cardiac event scared them both into action. She has a durable financial power of attorney naming Sarah. She has a revocable living trust naming herself as trustee and Sarah as successor trustee, with a contingent provision naming her younger sister Patricia's son if Sarah is unable. She has an advance healthcare directive. She has a HIPAA release. Between 2018 and 2025, she executed a Roth conversion ladder, converting $50,000 to $60,000 per year of her traditional IRA into a Roth, paying the tax in cash from her brokerage account each April, and dropping her traditional IRA balance from $487,000 down to about $42,000. The remaining traditional IRA balance is small enough that the RMD pressure at age 73 in 2027 is negligible, somewhere in the $1,600 range that first year. When Margaret A. receives the dementia diagnosis in May of 2026, her daughter Sarah obtains the 2 physician letters, presents them to the bank along with the trustee documentation, and assumes trustee control within about 3 weeks. Sarah pays the memory care facility from the Roth IRA, tax-free. Sarah keeps the house in the trust for 2 more years until it becomes impractical to maintain it, then sells it as successor trustee. No court order, no conservator fee, just a normal real estate transaction with the proceeds going back into the trust and continuing to fund Margaret's care. Total administrative cost over the next 6 years of Margaret A.'s care, somewhere in the $14,000 to $22,000 range, mostly accounting fees, occasional trust amendments, and the standard CPA work for the trust's annual tax return. Total federal tax paid on distributions during care, under $9,000. Inheritance ultimately passed to Sarah and the grandchildren upon Margaret A.'s death in 2032, approximately $420,000 to $480,000, depending on market performance. Margaret B., the unplanned Margaret, the one we have been describing all along. No durable POA, no trust, no advance directive. The conservatorship runs for 6 years. The IRA gets liquidated to fund care, generating ordinary income at increasingly punishing brackets. The house gets sold by the conservator with a 6% realtor commission and a 1% conservator fee on top. The bank accounts get frozen for 10 weeks during the initial conservatorship hearing. The conservator bills $7,400 a year on average. The attorney representing the conservator bills another $4,200 a year. Court costs add another $1,800 over 6 years. The bond premium adds another $2,500 a year. Total administrative cost, roughly $84,000. Total federal tax paid on distributions during care, approximately $138,000. Inheritance ultimately passed to Sarah and the grandchildren, somewhere in the $180,000 to $220,000 range. The gap between these two outcomes is approximately $240,000. That is roughly half of Margaret's net worth, evaporated by the failure to execute 4 legal documents and 1 tax strategy. Half. This is not theoretical. This happens every day in every county courthouse in America. The data from the Conference of Chief Justices shows somewhere north of 1.3 million active adult guardianships and conservatorships currently in force in the United States, with new filings of approximately 250,000 per year. The average duration is just under 6 years. The vast majority involve adults over 65 with cognitive decline. The Senate Special Committee on Aging estimated in 2024 that aggregate financial exploitation through guardianship and conservatorship abuse may exceed $5 billion annually, though the true number is impossible to verify because state probate records are not consolidated into a national database, and the National Center for State Courts has been requesting funding to build one for over a decade. You are not going to wait for the system to fix itself. You are going to fix yourself. Now I'm going to give you Florida, Ohio, and California. 3 states, 3 different conservatorship traps with 3 different specific dollar realities. Florida. Florida calls it guardianship of the property, and the Florida statutes governing it are in Chapter 744. The state has a relatively functional public guardian system, but the standard private guardianship fee structure runs about $85 to $140 per hour for a non-attorney professional guardian. The court requires annual accountings filed every spring. Bond premiums are mandatory on guardianship estates above $25,000, which is essentially every retiree we are talking about, and the bond costs roughly 0.5% to 1% of the bonded assets annually. For Margaret's estate, the bond alone runs $3,000 to $5,000 a year. Florida is also a homestead state with strong creditor protections on the primary residence, but those homestead protections do not survive a guardianship sale order. If the guardian petitions to sell, the homestead protection does not block the sale. The good news in Florida is the lack of state income tax, which means Roth conversions executed by Florida residents face only the federal tax. No state piling on. If you live in Florida and you are sitting on a large traditional IRA, you have one of the strongest geographic advantages in the country for executing a multi-year conversion letter. Use it before the moving van shows up to take you to your son's place in New Jersey, because the moment you become a New Jersey resident, the New Jersey state income tax stacks on top of everything. Ohio. Ohio guardianship operates under Ohio Revised Code, Chapter 2111, and is administered through county probate courts. Each county runs its own probate court somewhat independently, which means the experience in Cuyahoga County, Hamilton County, and Franklin County can vary significantly in fee structure and approval timelines. Ohio requires guardian fees to be approved by the court, but the typical range runs $75 to $125 an hour for professional guardians. Ohio has a state income tax that tops out at roughly 3.5%, which means a Roth conversion executed by an Ohio resident adds a small but real state tax layer on top of the federal bracket. Importantly, Ohio eliminated its estate tax in 2013, so the post-death side is clean. The trap to watch for in Ohio is the Medicaid Estate Recovery Program. Ohio aggressively pursues Medicaid recovery against the homes of deceased recipients under 42 U.S.C. Section 1396p(b), which interacts with guardianship in ugly ways if the guardian has spent down assets to Medicaid eligibility levels during the ward's lifetime. The recovery can hit the house even after the trust is created, if the trust was created or funded inside the 5-year look-back window. Plan early or you plan badly. California. California is the worst state in the union for an unplanned conservatorship. Full stop. The state's Probate Code Section 1800 series governs the process, and the fee structure is the highest in the country. Professional conservators routinely bill $150 to $250 an hour. Attorneys representing conservators bill $400 to $700 an hour. The annual accounting requirements are extensive and require detailed source documentation for every transaction above $100. California also has the highest top state income tax bracket in the country at 13.3%, which means Roth conversions executed by California residents face the combined federal plus state hit. For a high-income year, the combined marginal rate on a conversion can run north of 45%. The strategy for California residents is more compressed, fewer, smaller conversions over a longer ladder, sometimes 10 or 12 years instead of 6 or 8, and the case for the revocable living trust as the primary defense is overwhelming. Without a trust, a California conservatorship can consume 15 to 25% of an estate over a typical 6-year duration. With a trust, the cost drops to under 3%. If you live in California and you are not in a trust, you are donating money to the probate bar. 3 states, 3 sets of rules, 1 identical risk if you have no documents on file. Now here's the part where I tell you what to do tonight, not next week, not after the holiday. Tonight. Pull out your phone, hit the share icon on this video, send it to one person, just one. I want you to think for a second about who in your life is the most vulnerable to this exact scenario. The widow who keeps saying she'll deal with the paperwork next year. The retired teacher who told you in March that her doctor noticed something on her memory test, but it was probably nothing. The 73-year-old neighbor with the paid-off house and the IRA, she rolled over in 2009 and has not touched since. The cousin in Phoenix or Tampa or Sacramento who lost her husband 2 years ago and has been functioning on autopilot ever since, paying bills with the same methodical patience she used to make sandwiches for the kids in 1981. Send it to that one person, not as a lecture, not as a warning, as a friend forwarding a video that might save them $240,000. One conversation now saves them a $240,000 hole later. They can ignore it if they want. That is not your problem. Your problem is whether you took the 30 seconds to forward it. If you do not forward it and they end up in Margaret's position, and Sarah ends up dealing with a 6-year conservatorship in a state they have never visited, you will remember that you saw this video and did not send it. That is the kind of regret that does not pass. Then this week, ideally tomorrow morning before you talk yourself out of it, call an estate planning attorney in your state, not a financial advisor, not your CPA. An attorney who is board certified in estate planning or elder law. The fee for an initial consultation is usually free or under $250. Ask them 3 questions. Do I have a durable financial power of attorney executed under current state law? Do I have a revocable living trust funded with my major assets? Do I have an advanced healthcare directive and HIPAA release? If the answer to any of those is no, schedule the work. Do not put it on the to-do list. Do not write it on the kitchen calendar. Schedule the appointment and put the deposit down. The deposit creates the commitment that the calendar entry does not. The window is narrower than you think. The average age of dementia diagnosis in the United States in 2026 sits somewhere in the early to mid-70s for the most common forms, and the period of mild cognitive impairment that precedes a formal diagnosis can run 2 to 4 years and is often invisible to family members until something obvious happens, like Margaret on the porch in a winter coat. If you are 65 or older and you do not have these documents, you are running an actuarial race against a finish line you cannot see and cannot run faster than. The Alzheimer's Association published updated incidence data earlier this year, and the curve gets steeper every birthday after 70. The IRS is patient. The probate court is patient. The conservator industry is patient. They are waiting on the other side of the diagnosis, and they have been waiting for 40 years, and they are very good at what they do. They do not need to chase you. You will walk in, hit like, subscribe, hit the bell, save this video to your private library, bookmark it, add it to a watch later, screenshot the title, however you keep things. This is your survival manual. Send it to one person tonight. Call the attorney tomorrow. Fund the trust within the next 90 days. Start the Roth conversion ladder in your next tax planning conversation. Name the successor trustee in writing. Tell that successor trustee where the documents are physically stored. Put a copy in the fireproof safe and a copy in a sealed envelope with your daughter. Stay sharp, stay angry, stay specific. The conservatorship trap was built for the retiree who does not know it exists. You know now. Go act like.